some more crude oil talk. Should you sell crude oil again? We did a little bit of this in the platform here today, but I want to go a little deeper with some statistics and with some visuals for you all, and impart some of the wisdom that I got from my buddy Larry, who I used to trade at the Chicago Board of Trade with. Very thankful to have. Always great when you come out of school and you land at your first trading spot, and the guy next to you has a few decades of experience on top of you, has bounced around market makers and everything else. And Larry's whole thing was, you can trade something twice. If a market is up on Monday and you sell it and it's a winner, and then it's up on Tuesday, you sell it, it's a winner. If it's up on Wednesday, don't sell it. It can't happen. Third time is not the charm. It's not going to happen. And so I always think about this, because we've got a crude oil market that, continues to display big moves here up at the highs. And I'm questioning myself, with Larry in the background, is this selling crude worked for you all last week? Can it work again here? And we'll get into some stats around that and some mechanics to make sure that this isn't that daunting of a question. But before we do get into that, I always think this is a good time to highlight why we talk about price extremes, why we talk about standard deviations, why we assign so much probabilistic modeling to markets, because it's no coincidence, friends, that crude oil is seeing some of its best price action, some of its most opportunistic trading from a day trader's perspective, or even from a swing trader's perspective, some of the best back and forth we've seen in crude in months. And it's no coincidence that this is happening at the highs. It was the same. Remember when some of those crude oil futures, as the pandemic news is coming out, one of those futures contracts goes negative, and other futures are getting down to $10 a barrel, $15, $20 a barrel. And you're seeing big sell-offs and big rallies in crude at that downside extreme. Some of the best trades in there, and people talk about in 2021 and now in 2022, man, that was a great trade. I wish it was like, markets tend to show their best trades at extremes. And so I just want to highlight again, like, why we're always highlighting markets that are at extremes when they're outside of their range. Crude oil is not as interesting, not showing as much opportunity at $70 a barrel, but when it's up at prices that it's not usually at, above $90 a barrel, there's a lot of interesting price action. Why? Because it's at an extreme, and traders are trying to figure out, should it be at 100 or should it be back down at 85? You get the big swings, you get the good opportunities. And so that's why we look at stuff like the standard deviation. And when I say some of the best price action, some of the best opportunity, I'm speaking almost directly to a market that moves outside of its range and comes back inside. From a contrarian standpoint, from a day trader standpoint, this is some of the best price action, because we want stuff that moves, that we want that rubber band to expand and then that rubber band to come back in line. We want markets to go out. If a market's inside of its normal everyday range, I don't really have anything for you unless I want to start formulating opinions around where I think crude oil should go. But when it moves outside, then I can hang my hat on going against that move and the market returning to normal. And we saw last week, this market moved outside of its range at some point in the midday, only to close inside of that range every single day. And that's incorporating on Thursday a 3 standard deviation move. The market, 3 standard deviations in this market happening less than 1% of the time. Crude oil rallying more than $6. We had a more than $7 rally in crude. And that day it came all the way back and closed inside its 1 standard deviation range. Very rare moves. But this brings up this idea, like, man, does this stuff work again? Because you have on Tuesday, it wasn't as big as Thursday, which we'll get to in a second, but net change of 0, where the market closed the prior day around $91, gets all the way up to 93.5, comes all the way back to $91. On Wednesday, almost the same exact story to a T. Net change of around $91, gets all the way up to 93.5, comes all the way back to a net change of unchanged 0 on the day. Now you look at Thursday, where SMO, which starts trading around 7 a.m. Central Time, opens up at almost $100 a barrel. The one standard deviation move being around 94 bucks, 93, just like we're seeing on Tuesday and Wednesday, gets all the way up there, multi-standard deviation move, and comes all the way back to unchanged on the day. Now, that's very rare. Like, when I'm in a market like this and I'm in there at like 8:30 and I sold this SMO around 98 or 99 bucks, I'm thinking if this thing can get back to 97 or 96, I'm having a field day. That'd be great. Let alone and of course I closed my position around 97 or 96 or whatever it was. No intention when you see a 3 standard deviation move that the market come all the way back, but it did. And it begs this question of, well, now it's Monday of the next week and the market's up $4 or $5 up above a standard deviation. What do I do? And of course, if you aren't feeling good about it, it doesn't have the right vibe, then you can stay away. There's nothing wrong with that. But if you traded on Tuesday and Wednesday and then missed Thursday, that kind of stinks. And now also, if you're talking yourself out of Monday as well, that stinks as well. And so what I would push, and what I always push for people to do in scenarios like this, is just be consistent. Like, ask yourself, if Monday's day today up $4 or $5 in crude was a random day a few months ago, would I be trading this? And if the answer is yes, then, of course, these are specific times where there's a lot of geopolitical risk at play, but you have your mechanics set. The opportunity is there, and it's not usually there. If you've been trading crude the last several months, we don't get $4 rallies, or like we saw on Thursday, $8 rallies. It doesn't happen every day. But if you got your mechanics, you should be good. And if it's something that you'd usually do, I would say don't scare yourself off with some kind of paranoid, oh, this is the time it's going to break. Because there's no statistical basis for what my buddy Larry said, which is like, oh, that third time it can't work. Of course, the market is memorylessness to a point, is memoryless. Sorry. The property of memorylessness states that the market on a Monday will act without any memory of what happened on Friday, Thursday, or whatever of last week. So just make sure you've got your mechanics ready. And these are my mechanics. This is something I actually committed today. I sold the market up $2 or $3. It rallied $1 against me. I got out. And now if it rallies another buck, I can get right back in. Market like this, mechanics are essential. Be consistent with the way that you're trading. Don't talk yourself in or out of stuff you wouldn't normally do. And you should be good to go. And also, of course, stay small, as always, in volatile markets like this.